Welcome to today's deep dive, everyone.
Sure.
What if you could capture the profit of a massive swing on like a $500 tech stock without ever actually fronting the cash to own a single share?
Yeah, it sounds a bit too good to be true, right?
It really does. But that is the exact promise of a stock CFD, or a contract for difference. Today, we are unpacking a guide called Stock CFD Trading Explained Simply to figure out, how these instruments offer such rapid market access.
Right, and frankly, whether they are a brilliant strategic tool or a trap for unwary traders.
Exactly. Because, well, many assume trading requires massive capital and a decades-long time horizon.
But stock CFDs completely flip that entirely on its head. You are basically trading under a completely different set of physical laws.
Okay, let's unpack this. Because before we even discuss the risks, we have to define what is actually being traded here. When you trade a CFD, you aren't buying the stock.
No, not at all. You don't own the underlying asset.
Right. It is more like betting on a racehorse instead of buying the horse itself. You don't own it, you get no voting rights, and you get absolutely no long-term shareholder benefits.
What's fascinating here is the actual mechanics of that contract. You and the broker are simply agreeing to exchange the difference in a stock's price from the moment you open the trade to the moment you close it.
Wow. So if I buy a contract for a $100 stock and it rises to 105, I just make $5 per contract.
That is exactly it. And crucially, you can also effortlessly open a sell position. So if you think the stock is going to drop to 95, you can profit from that downward move just as easily.
Wait, really? Just like that?
Yeah, just like that. Since you never have to locate and borrow the physical shares to actually sell them, you just open a contract predicting the price will drop.
Okay, so we're just trading the price difference. But here's where it gets really interesting. Because you are only trading the difference, CFDs introduce their biggest draw, and honestly, their biggest danger, which is leverage.
Oh, absolutely. Leverage is the defining feature here.
Is leverage just like a psychological trap? Because you only deposit a margin, right?
Yeah.
You're controlling a much larger exposure with way less capital.
If we connect this to the bigger picture, leverage makes your capital super efficient, but it magnifies both your returns and your losses. Small price moves hit the account really hard.
Right, so if you're on, say, 20-to-1 leverage, a tiny 5% drop wipes out 100% of your margin.
Exactly. The broker isn't going to absorb that loss, so you just get liquidated. But profitability isn't just about market direction. It is about the net outcomes after all the hidden costs.
Wait, hidden costs? Like what?
Well, things like the spread between the buy and sell price, overnight financing, and even dividend adjustment.
Oh, wow. Overnight financing. What exactly am I financing if I don't actually own the stock?
You are effectively borrowing capital from the broker to fund that massive market exposure. So if you hold it overnight, they charge you interest on that borrowed money.
So holding a CFD for weeks could literally eat all your profits.
Yeah, time literally costs you money. It can easily transform a winning stock pick into a net losing trade. Multi-asset platforms like Monaxa, for example, offer all this flexibility in one place. But convenience does not equal suitability.
So what does this all mean? Because since risks are so magnified, how should a trader approach CFDs without just blowing up their account?
Well, discipline is everything here.
Right, because a beautifully clean chart setup means absolutely nothing if your position size ruins your account's risk tolerance.
Exactly. This raises an important question. Beginners must ask themselves, why this stock, why now, and what proves my idea wrong?
That makes so much sense. So you have to define your entry, your stop loss, and your profit targets before you even execute the trade.
You have to. If you don't do that before clicking the button, you fall into overtrading or, chasing losses. Once that leveraged trade is live, human psychology kicks in and decision quality just drops to zero.
Yeah, planning ahead is the only way to avoid panicking when a small dip looks like a massive hit. So I guess the ultimate takeaway from today's sources is that CFDs are a highly specific instrument.
Definitely. They are built for active, short-term price speculation.
Right. They're definitely not for long-term investing.
No, not at all. Used correctly, they give retail traders incredible strategic flexibility, but they demand a level of risk management that traditional stock buying simply doesn't.
Which leaves you, our listener, with a final question to chew on today. CFDs strip away all the friction and operational steps of traditional stock ownership.
Right. Instant execution, massive leverage.
Exactly. But if we remove all that friction, does making it that easy to put our money instantly on the line actually make us worse decision makers?